What's going on, guys? This is Lior and welcome back to the channel. I've had so many of you guys reach out and ask me about a lot of the intricacies of what it takes to pull a commercial loan, right? And how it's actually different than a residential loan. If you've potentially been thinking about doing your first real estate project, right? You will probably come to the point where you need a commercial loan rather than residential. So I'm gonna tackle the differences between residential versus commercial so that you guys really understand the fine lines of what to expect, especially if you've never gone through the process, because there are differences, there are different regulations, there are different things you can negotiate. So hopefully that's helpful for you guys if you're thinking about taking out your first commercial loan in the near future. So before I actually get into what you can negotiate with the lenders and some of the differences between commercial versus residential, let's actually give some examples of different types of commercial loans, right? So again, if you're doing something like, say, a fix and flip, you're probably gonna fund through something called a hard money lender, right? So hard money lenders is one type of a commercial lender, typically used for quick in and out flips, not really used for rental properties, but those are the kinds of loans that are quick. You can close in like, say, 2 weeks, 3 weeks, and you'll see a lot of flippers use them over and over again. They're really meant for that specific purpose, right? Of funding a flipper, getting in quickly, getting out quickly as well. If you're maybe going through, let's say, a commercial property, right? Maybe you're buying like a multifamily, maybe you're buying like a value add project or something, right? Where maybe it's not a gut rehab, but you just got to fix up a little bit. Then maybe you can go through a community bank, right? And the advantages of a community bank that's different than a hard money. It's a community lender, right? It's someone that literally works in your backyard. Hard money lenders can be local, national, all across the country. But that community lender, the advantage they're gonna have, even though they can't move as quick, they will typically have much better terms. They're gonna be less expensive, the rates are gonna be lower, but on the other hand, they're gonna be slower moving, right? They're not gonna be able to close a deal in like 2 or 3 weeks like a hard money lender. Just does not happen. So you've got the hard money lenders, you've got local community banks, and if you're really going after some big projects, you might use what's called some agency debt, right? So that's Fannie Freddie loans. Typically you see those on larger multifamily acquisitions. You need much bigger loan balances, right? You can't buy like a $500,000 or $1 million property with these kinds of loans. I've actually personally never used them yet. I've only used community banks and hard money. I am probably planning on using it at some point pretty soon. Once we buy kind of our first bigger property, maybe 20 or 30 units, but haven't been there yet. So those are kind of the three big buckets I like to categorize. The lending in, the hard money, the local community banks, and then you kind of got your agency lenders. You kind of have some in between, but that's how I like to think about those. So hopefully that intro to commercial lending made sense. I'm gonna get into the differences between commercial lending versus residential lending, as well as talk about some of the things you can negotiate it versus not. I gotta first hop over. I am checking out a 6-unit property today in a Boston neighborhood. So I'm gonna go drive over, tell you guys a little bit about the property, and then again, get into the differences between residential and commercial. So let's hop over there and we'll keep this ship sailing. All right, so I just pulled up to my first stop. Let me go into the second point about commercial loans. And now that we kind of talked about the different types of commercial lenders out there, the second point you got to understand about commercial loans is it's kind of like the Wild West a little bit of real estate, right? And here's what I mean. With residential real estate, when you're doing a loan, right, it's very regulated, right? Especially after the fiasco with 2008 and everything. There's a bunch of guidelines, regulations that on the residential side have to be met when you're taking out a loan, right? There's just certain things you can't finesse or, do anything creative, right? Because, it's a consumer product meant for the majority of people who are looking to buy single family, primary residence homes or single families or condos. Now, on the commercial side, it's different, right? On the commercial side, you're kind of just, it's you and the bank, right? There's not like a bunch of oversight and guidelines as much as on the residential side, right? Just think about it. On the residential side, most loans that are done are typically packaged off and sold as securities. Whereas on the commercial side, a lot of the loans, especially if you're dealing with community banks, right? So if you're dealing with local community banks, local lenders, a lot of those loans are possibly kept in-house. So it's just really direct you to the lender. So my whole point about telling you all this is you kind of have to be a little bit more on the lookout, if you will, when dealing with these commercial loans. Not to say anyone's like purposefully trying to screw you or anything like that. By no means am I suggesting that. But, you know, when you are on the commercial side, everything's just kind of floats a little bit more. So it's really up to you to just make sure everything you're getting charged for is in accordance with what you agreed with the lender up front. And this also goes for any adjustments when you close, right? So if you guys know, when you close on rental property, you typically have different adjustments like tax adjustments, rental adjustments, deposit adjustments, right? For like security deposits, last month's rents, that kind of stuff. You really are the one responsible to make sure that, hey, all of these deposits were done correctly, right? So anytime I get a closing disclosure for a commercial loan, I will literally crunch out the numbers and make sure all of them are aligned with what I think the numbers should be. Not to say I didn't do that when I bought with a residential loan, because I certainly will. I'm just a little bit anal myself. But on the commercial side, again, numbers can kind of be fudged. And I've caught errors before, right? I've caught errors on closing disclosures where proper rental adjustments weren't done, proper deposit adjustments weren't done. And once I got charged like an extra fee that I had already paid up front. So you just kind of got to be a little bit more sharp when you're dealing with the commercial side. So hopefully that tip makes sense. Again, not trying to scare you guys and not trying to say people's out there to screw you, but you just want to kind of be super sharp when you are looking at the commercial loans and kind of analyzing those. So with that, I'm going to head off into my showing. The owner is actually just on pull up. So I'm going to go check out the building. By the way, look at these buildings. This is one of the reasons I love Boston. These brick brownstone buildings just literally tug in my heart. I mean, they are gorgeous. And that's why I've been trying to buy more and more brick, because I'm just so obsessed. I mean, look at that. All right, so I just pulled up to my next stop, had to do a quick check on one of our active construction sites, which you can see right behind me. I did a separate video on this one if you're interested, but with that, let's get into tip number 3 about working with commercial lenders. And that's that a lot of the rates and terms, and basically the whole loan package, a lot of it is negotiable, right? And that's really one of the beauties of using commercial lending versus residential, right? Because with residential, it's basically you kind of take what you get, right? I mean, residential, you're gonna buy an investment property, you're probably gonna get a 25% down loan. It is what it is, right? Not much you can do to move away or from that. You can maybe shop the rate a little bit or whatever. I'm gonna try to do a little better here or there, but for the most part, nothing crazy. Now, with commercial, what's really cool is you can really kind of adjust the package depending on the kind of deal you have. So what I mean by that is the different terms of the loan package can be adjusted, right? So things like loan to value, obviously, right? That's the number one thing that can be adjusted. I've had banks offer me anywhere from 70 to 80% loan to value on the acquisition side, but also then on the construction portion, right? Because if you're taking a commercial loan, you're probably gonna be doing some sort of rehab, whether it's a full gut or just a little value add. So on the construction side, I've also had offers from banks to finance 80 to 100% of the construction, again, depending on the deal and how I want it structured. Another thing that you can also get negotiated is the amortization of the loan. So again, with residential, 30 years pretty standard. With commercial, you have options anywhere from 25-year to 30-year, and you actually also have 35-year options too. Now, 35-year, I would say, is definitely less common. You know, with 35 years, you're typically looking at agency debt, which again, as I said, I don't really have that much experience with, but I know it's certainly possible. But again, you can kind of customize the package. If you wanted, for example, a 25-year amortization period, you could certainly get it. You can also talk with your lender about term of the loan, right? So typically on the commercial side, you'll get a 5 or 10-year term, right? So that means the loan balance is due after 5 or 10 years. But again, even though that's kind of like the conception in the industry that that's typically what it is, I've had banks offer me 20-year terms and even 30-year terms. I'm actually doing a refinance on with a commercial loan right now, where I'm getting a full 30-year term loan on the commercial side. So, you know, just because that's kind of the conception in the industry doesn't mean that all of them are like that. And other things too that you can figure out with your lender, things like interest-only periods, right? So I've been offered interest-only periods of as little as 6 months to 12 months. We actually have one out that's 18 months. Again, that's huge, right? Because with an interest-only period, especially if you're doing some sort of stabilization or construction, it gives you that flexibility of, cutting your mortgage costs while you're doing the renovations and everything, which kind of frees up your cash flow and kind of lets you do what you need to do to stabilize, right? So that's really the cool thing about it is you kind of really customize the loan package to exactly what you need, depending on the kind of project you have, depending if there's construction, depending if there's stabilization, or whatever it is.